Hey guys, welcome. By the end of this video, you will learn a secret to differentiate between market structure shifts and liquidity grab. First off, let's look at what a market structure shift and a liquidity grab looks like. So let's assume we are anticipating a bullish move and price moves above this structure high. And going forward, price delivered all the way to the buy side. This move above this particular structure high right here is a market structure shift. On the other hand, on this piece of price action, we can see that market structure is currently bullish and price has clearly moved above this particular structure high right here. So going forward, we'd like to see price retrace and push higher. But let's see what price does. But we can see how price delivered all the way to the sell side. This move above this particular structure high right here is a liquidity grab. So now, how do you tell the difference between a market structure shift or a liquidity grab? In other words, how do you tell when a liquidity grab is about to occur or when a market structure shift is going to hold? The secret and the answer is fair value gaps. So let's use this particular piece of price action we used earlier to identify a liquidity grab. So right here, we can see price have moved above a structure high right there. So what we want to identify is a fair value gap that occurred while price was taking out this particular structure high right here. So right here on the daily time frame, we can't see any clear-cut fair value gap that's occurred while price was taking out this particular structure high. So we drop down to the lower time frame like the 4 hours. And right here on the 4 hours, we can see that price created a fair value gap while taking out this particular structure high. So we want to mark out that particular fair value gap right there, because that will determine if this move above this structure high is a market structure shift or a liquidity grab. So if it's a market structure shift, we want to see price respect this particular fair value gap and push higher. But if it's a liquidity grab, we want to see price engulf this particular fair value gap, making this particular fair value gap become an inversion fair value gap. So let's see what price does. We can also see that price returning back into this particular fair value gap created another fair value gap right there and engulfed it completely. So we already have an inversion fair value gap, but we want to see how price reacts from this particular fair value gap going forward. So let's see what price does. And now we can see how price displays lower, engulfing this particular fair value gap created right here, qualifying this particular move above this swing high as a liquidity grab. And going forward, price delivers all the way to the sell side. So you can see how observing fair value gaps kept us on the right side of the market. Now going over the example we used to identify market structure shifts earlier, let's see how observing fair value gap will help us qualify a market structure shift. So right here, we've identified a structure high. And now we can see price has moved above this particular structure high right here after giving us a run on liquidity. So now we want to pay attention for fair value gaps while price was taking out this particular structure high. And right here on the daily time frame, we cannot see any clear-cut fair value gaps, so we'll drop down to a lower time frame. So right here on the 4 hours, we can see as price was taking out this particular structure high right here, which we identify from the daily time frame, price created a fair value gap right there. And you can see as price has come back into that fair value gap to fill it completely. So if this is going to be a market structure shift, we want to see how price is going to respect this fair value gap, pushing up aggressively. Otherwise, we want to see how price is going to engulf this fair value gap, making it an inversion fair value gap. So let's see what price does. Now right here, we can see how price on this particular candle engulf this particular fair value gap right here, making here seem like an inversion fair value gap. But we can see with the benefit of hindsight that price pushed higher, invalidating this entire inversion fair value gap. Another way you would have avoided this particular move right here is to use multi-time frame analysis in terms of looking at a much more lower time frame for more fair value gaps. And dropping down to the 1 hour, we can see that the reason why price pushed lower was to fill in this particular liquidity void right here. And the moment price took out this low and took out this low right here, we can see our price pushed higher, giving us an inversion fair value gap right here at the close of this particular candle. And you can see the way price retrace on this particular candle right here with this wick right here. You can see the way price pushed up aggressively. So while trading, most times you want to qualify the fair value gaps using multi-time frame analysis. So you want to be looking at least a minimum of 3 time frames to see if price is actually reaching for deeper discounts or deeper premium, as we can see in this particular case. So going back to the higher time frame, here on the 4 hours, we can see how price default this particular inversion fair value gap right here. So we can capitalize on this particular move to see price push higher all the way to the buy side. So let's see what price does. And there we have it. So you can see how price capitalized on this particular fair value gap, pushing price all the way to the buy side. So I hope this idea makes sense to you, and I hope you find value in today's video. If you do, hit the like button, hit the subscribe button, and see you in more videos.